All right, we are live. Today, another episode of FUD with Friends, and our good friend here, Mr. Firestorm. How you doing, man?
I am doing great, man. How are you doing? It's been a while, huh?
Yeah, it's been a little bit. We did a few podcasts, in years past, but
right.
it's definitely been a minute. That was the old days of the Dexalot.
Right.
What was it, Into the Club?
Yeah, we had you in the club for a few times. I've actually been a guest on your show before as well.
Yeah,
I miss it. I'm not going to lie. This is one of those things where you and I feel like we think almost along the same lines. So, I miss these conversations. So glad to be back.
Beauty. Do you want to do like actually, first I'll kind of introduce what we're talking about. Something that we've talked about over the last couple of weeks on the show has been some news and kind of some happenings around new liquidity mining programs and so on. Today, as you have a pretty good breadth of experience, what we're covering is liquidity mining. What is it? How does it impact a project? How do project developers think about it? How should investors think about it? And we will cover all of that crap. So hopefully by the end of about 30 minutes, people will have a good understanding. As always, if you're watching this right now, remember the links to all the articles will be posted under the videos as a comment. So if you want to actually visit some of these articles, and in today's episode, there's a few that have pretty good background information. They're always there. Without further ado, let's frickin' go. Come on, Nikki. All right. So before we get into it, obviously I'm really excited to chat with you in particular about this. But maybe just for the people that aren't familiar with who you are,
Sure.
Give them a quick blurb about who you are and what you do.
Yeah. The very short is I'm Firestorm. I spent most of my career in Wall Street. I'm an engineer by training. I worked at various large banks, primarily focusing on electronic trading, and my most amount of time I spent was in FX algorithmic trading. I was at a large bank right prior to going full-time in crypto. I currently am obviously full-time in crypto. I'm doing a few things. Most importantly, most people know me from Dexalot as the head of strategy. But I also founded a company called Firestorm Capital, which essentially is a small fund that we're managing, again, algorithmically. And I've been, operating as a sort of strategy guy, trying to help as many projects as possible and grow the pie for everyone, essentially.
Beauty. And I mean, for those of you who don't know about Dexalot, really cool concept on Avalanche, definitely worth checking out. You guys just had a bunch of consecutive all-time highs in volume and transactions.
That's right. Liquidity mining is important. We did figure out a few levers that make sense, so we can definitely talk about them.
Beauty. All right. Well, I'm just going to spend a couple seconds here. That's probably an understatement, but a few seconds just talking through a couple of articles, just setting the stage. So 3 Sigma blog came out with an article a while ago now, but essentially it just talks about how liquidity mining, at least in its initial iterations, were inflationary, and it boosts liquidity by rewarding users for staking or providing assets into DeFi protocols. Many, including Lyra, Notional, a whole bunch of others, Benqi, Dexalot, many DeFi protocols rely on these token emissions to help incentivize longer-term participation, but also to increase the yield to a level that is, generally speaking, acceptable for taking on the risk of novel products. So, excuse me. Essentially, there's a bunch of other ways that token emissions have now been introduced, but we're going to, at least for now, talk about them for the purpose of today's conversation from the perspective of, attracting more liquidity and so on. We're not going to talk necessarily about DAOs and some of those types of emissions. Another article that's definitely worth checking out is one from Cointelegraph. And they did some research and talked about this essentially from the perspective that inflationary tokens, of course, will ensure market liquidity by maintaining a steady supply, smooth transition or transactions and staking. But obviously, increasing supply may reduce purchasing power, kind of like inflation of the US dollar, or requiring a careful balance between understanding how much you're going to emit and the resulting expected demand. So again, we will post the link for that article as well underneath the video. Definitely worth reading. If you're new to this, Firestorm and I will talk a little bit about why this matters in a little bit. But this is something that, if you're not completely familiar with, is definitely going to be worth your time. All right. So we're going to talk a little bit now, and we're going to bring in Mr. Firestorm on this one, but we're going to talk a little bit now about real yield. And it's kind of the holy grail, so to speak. Well, a lot of us are talking about, it's become a fairly strong narrative now, is how to source and build sustainable real yield. So in the past, as this article suggests, it's by Sebavo, who I don't know, but it's an interesting article.
I used them, funny enough. I did use Sebavo as a part of our multi-sig, not exactly custodian, but security solution on the fund side. So I do know them. Circle acquired them, actually. Yeah, I did use them.
Well, then they definitely have a little bit more credibility if they're owned by Circle. But this is, I think, a little bit obvious. But early DeFi protocols, if you remember, DeFi Summer and Yam and Farm and Ample and Pickle, like there are so many of these things that essentially relied on these token emissions. And I have some anecdotes, and I think you do as well, Firestorm. But it has led to, in many cases, and we've seen this play out a little bit, unsustainable inflation. So as we're all starting to talk about real yield, how do you view kind of that relationship between transitioning from absolutely unsustainable inflation to starting to incorporate real yield? How do you think about that?
Yeah, I mean, first, the way I kind of observed it from beginning to end, right? And it was quite interesting to see. So the initial sort of phase or meta in the market was that people did exactly what you were talking about in terms of emissions, right? They did programmatic emissions, which was touted to people as yield, right? Oh, we're going to have an exact formula. We expect all of our emissions to end in 3 years, 5 years, 20 years, whatever that may be. And if you come and do something that we want you to do with respect to the project, whether it's staking some of your assets, whether it's playing a game or whatever, you're going to get more of our tokens, right? And people called that yield. In the 2021 cycle, it was pretty apparent because it was pretty short-lived. I'm sure every degen that's watching this will remember that programmatic emissions did not work well, or they could work maybe, but it's very difficult to get the schedule right because you're not just contending with your own project's ability to acquire users, you're also contending with the macro headwinds, right? Or tailwinds, depending on which direction you're looking at. Therefore, people, I think, switched to not emitting at all, right? Then you had the FTXs of the world and various other people that I'm not going to go through and name, but ultimately the strategy ended up being, hey, let's not emit at all. Let's emit a tiny amount. Our investors get a big bump. People we'll create a narrative, the value will go up, and then people also call that yield, if you can believe it or not, or P&L, if you will.
Yeah.
And we know how that ended in 2022, right? Now, the way I think that will have more longevity is exactly what you said, which is the real yield, i.e., me as a project, I have to create some utility, whether it is making my life better or whether it is giving me entertainment value. There has to be some utility, right? And that utility is going to be driving some yield for me, right? If it's possible. In the case of, I think Uniswap is probably a very good example of this nowadays.
Yeah.
Very controversial, right? They're an exchange, a different kind of exchange than Dexalot. I'm not going to go into that, but the first one, very successful one. And their utility is, hey, if you come and use our platform, we're going to earn some fees. Some of those fees are going to go to the people who hold my token. And ultimately, the money you receive is not in the form of my own emissions. It's in the form of the yield that my platform generates by making somebody else's life better by providing them trading services. So I am a believer in real yield. I do recognize that it's very difficult to produce nowadays because crypto is very small still, right? The audience we have today, obviously, looking at how handsome you are and how an amazing podcaster you are, we should have hundreds of thousands, maybe millions of people watching, but we only have a few hundred, right? But I think real yield and these types of ultimate utility that people call it utility will drive the growth of platforms. Anyways, I feel like I spoke quite a bit, but that's how I look at it.
No, man, that's amazing. That's exactly why we have you on. So appreciate it. So I mean, like as a protocol founder, which is what I also spend some of my time doing besides podcasting with my Doge friend here. But as a protocol founder, it's a bit of an art and a science, and that in and of itself is a challenge. It's a problem. Because in a vacuum, we can look at modeling all types of scenarios. And we've had quant firms and tons of different groups supporting us, tokenomics consultants and all of these other people. And we can model it in a vacuum really nicely. We can say, hey, here's this emission schedule. Here's an expected historical growth rate of TVL and yada, yada, blah, blah, blah. And then about 10 minutes into launching the protocol, you realize that all of that is now completely not useful because consumer behavior is a little interesting. And so you made a really good point, actually. And for the producers, I'm going to skip the next article, by the way, but we'll show the other one after. You made a really good point. Now I lost my train of thought. God damn.
I can add something because what you're saying resonates incredibly well. So think about it this way, right? Ultimately, you have a project that you're launching and your token or whatever you're issuing is an integral part of it. Again, extreme emissions, I kind of look at all of these things in the or through the lens of supply and demand. Supply is your emissions, demand is your sort of people using your platform or the utility of your asset, and the intersection is where ultimately your price is going to be. And if you have good utility, you drive good demand, and your asset will end up staying alive and staying well, right? So in reality, all of these things are connected, and I kind of view them as a circle, right? You have to generate demand. As demand is growing, if you did what FTX did and you don't actually issue more tokens and you keep it on your books, sure, the price is going to go up because there's less for people to buy, but then in the macro headwind scenario, like macro event scenario, you die, right? Yeah. I kind of view, and I think games are very close to getting this right, where you acquire gamers, you issue tokens. You acquire gamers, you issue tokens. And ultimately, the yield that people get isn't necessarily money yield, but it's entertainment, right? Well, I don't know.
If you look at, sorry to interrupt you, but if you look at like even the Axie Infinities or the early days of YGG, Yield Guild games, it was all based on essentially inflationary token emissions.
Programmatic.
I mean, Axie during COVID completely changed the economics in the Philippines specifically, but other countries globally, which is kind of incredible. I did remember my point, but finish your thought here, friend.
No, I'm just saying, ultimately it ends up being circular. And I think games are in a prime position to do this. So imagine you have a game that actually has the ability to acquire gamers, whether it's through marketing or organic means. Now you have the ability to issue more tokens through campaigns. Hey, JD just started playing my game. I'm going to give him some free assets. He can go out and trade them in the market, or he can use those assets to build his empire of, to dominate aliens in my game, right? So like it's all hand in hand. And quite honestly, if you just think about how nation level economies are supposedly managed, I'm not going to argue they manage it well or not, but ultimately it's a managed economy, right? Of course. You have to look at the money supply. You have to look at the unemployment. You have to look at all these different metrics to decide if you should expand the money supply or shrink the money supply. And I think until we really have someone coming along proving that programmatic way of doing it works, the economies for now should be managed, and the real yield has to be attached to those economies for it to be attractive on the demand side. That's how I sort of collect and connect all the pieces in picture.
Absolutely. We're going to talk a little bit more. It might not actually be on the agenda, but we're going to talk a little bit more about kind of the impact of some of that switching of direct emissions to, these airdrops and participation dependent types of yield, if you want to call it that way. But you made an interesting point before that really kind of finalizes my thought on the art and science piece. And that is, you can do all of the things that you want, and you can be super prepared. You could even be right. But if the protocol next to you does something that completely deviates from what you're doing, you now have to compete with other people trying to manage that central bank or inflation, deflation. Now, even the largest economies in the world, the United States is a good example, which is where I spend most of my time, can't figure it out perfectly. So it is a very difficult task, and many people in this space, arguably us included when we first started, really didn't know what we didn't know. And it becomes, that's kind of where the art comes in. We both spend a lot of time living and building on Avalanche, my friend. And one of the obvious things that got Avalanche on the map was Avalanche Rush in 21, 22. And then now they've kind of followed on with that with Boost a little bit. And
absolutely,
again, it's not just at the protocol level, but it's also the ecosystem level that attracts the inflow of assets, and in some cases allows for the outflow of assets if you taper too fast, and so on and so forth. I've been a fairly vocal critic of liquidity mining for years because it's really not sustainable. We still do it because, like I said, if the protocol next to you is offering it, you have to offer it. But yeah, it's something that I'm really excited that the narrative is switching to, like you said, real yield. All right, so DeFi. We're gonna talk just a little bit about DeFi, and for the people that are watching, obviously, hopefully you guys are familiar with what DeFi is. But from your experience on Wall Street and so on, there's some big differences in managing businesses off-chain relative to managing businesses on-chain. So maybe you could explain kind of some of those differences and how you view that.
So, and I'm going to explain it in the context of Benqi, okay? When I talk to people about why Web3, why DeFi, I always mention Benqi. But ultimately, Web2, Wall Street, whatever you want to call it, is a 100, or actually 100 is exaggeration, but 99.9% trust business, okay? You as a bank will onboard a client. You won't truly have the way of knowing if that client is legit or not. You'll do your KYC, AML, and credit analysis, and you name it. But ultimately, you're going to trust them, right? If you give them a loan, if their loan collateral goes below the thresholds that you're looking, you're going to give them a phone call, and there will be some leeway there, right? If you're doing a trade on the exchange, most people don't know this. Let's say you're doing an FX trade on the one of the ECNs, as they're called. They're not exchanges, actually. And you end up with a trade where your trade is way off market. Let's say the euro is trading at 110. You somehow trade at 112. That's preposterously off market.
Yeah.
And the exchange and your counterparty, this is market sort of standard behavior, and everybody expects this to happen. They will come together and bust that trade because it's clearly off market. Versus DeFi eliminates the middleman. You no longer have a human in between. You don't have to trust anymore, right? When the trust is broken in Web 2, it's terrible, right? You trusted these guys, you gave them money, they disappeared. There's no recourse. DeFi makes a trade-off there where there is no trust needed. I always ask people, what do you think is a good use case? And when they can't give me, I always talk about Benqi. I'm like, dude, if you invested a bunch of assets, you can sell them, or you believe that they're going to still have value, you can put them on Benqi, and in 1 second, in one click, you can pull out a loan, and that loan will hit your wallet instantaneously. Versus a Web 2, you're going to have to go through a paperwork process. It's going to take 90 days. They're going to search your home. They're going to search your history. They're going to, strip search you. They're going to do a lot of things, and it's a different process, right? I'm just saying. And I feel like DeFi is definitely going in the right direction. We still need to figure out the, being no trusts. If a transaction is done, you can't reverse it. Like, there's all sorts of educational components that need to come in. But I believe, just wrapping up here, DeFi has the ability to really eliminate a lot of inefficiency in Web 2. all of those trust-based processes involve spending billions of dollars and throwing hundreds of thousands, maybe millions of humans at the problem to manage just the back end, right? Yeah. So, that's kind of how I look at the two.
Well, and that's, I mean, we could probably spend, and maybe we should, spend another podcast talking about some of the core differences in building businesses in the two environments. But I think this kind of comes back to one of our topics for today, in that, when you're thinking about building these structures, it's a little different, because although on a larger time frame you are setting somewhat subjective parameters, once you set the parameters, they're now trustless. Like, they're now built into the smart contracts and the protocol. And sometimes that can be problematic, especially if user behavior drastically deviates from your expectations. Now, there's some really interesting ways that protocols have been looking at, and we're not going to say this too directly, but at ways to distribute value as the protocols earn it, and emissions are sometimes a way to do that. One of the really interesting kind of new narratives that has come up, Ethereum, we can probably talk about the challenges with Ethereum right now, in that it was supposed to be deflationary, net deflationary. And because of the value transfer and a lot of the activity now happening on L2s, it has unfortunately remained inflationary.
That's correct. Yep.
And that's a bit of an issue. From your perspective, I know you've looked at this, not just from Dexalot, but from the perspective of a few protocols. How do you think about that? How do you think about the modeling and structuring things in such a way that it can become hopefully not just infinite inflation?
Yeah, absolutely. I mean, Dexalot is a beautiful case for this. Games, again, are going to be a good case. Ultimately, I am a believer of continuing to experiment with finite supplies, right? That's not what money is. Money today, fiat money specifically, is infinite supply, right? Any country can inflate. However, there is a world where, again, you can create a circular system, and I believe Dexalot is quite close to this, where the inflation and deflation are balanced or can be balanced through usage of certain levers. Dexalot, just to give you the very high level, is on its own blockchain, which allows Dexalot to have its own token that it gives out in incentives for people providing liquidity, market makers on the exchange. So you have to inflate it that way so that people have an incentive to come and provide liquidity to traders on the exchange. But when they're doing that, they have to expend a small amount of the token to place their orders. Now, initially, people don't necessarily see this, but when you actually add 1, 2, 5, 10, 20 market makers who are continuously making entering orders, canceling orders, or making trades, right? Now we have a system that does 1 million transactions a day. Soon it becomes 2 million. As we add more assets, as long as the blockchain itself can support this capacity, now you have real utility, which actually is better than traditional finance, because in traditional finance, there is no cost to entering orders. And a lot of, I'm sure you know this from your olden days, right? A lot of people entered fake orders with no bona fide intention to trade, right?
Totally.
Created a lot of problems. So we now have this model where we can give out incentives to people who are truly trying to provide liquidity, and then burn a little bit of our supply so that we have that circular working economy. Jury is still out, but what we've done with Dexalot so far is working, right? As volume is increasing, transactions are increasing, our ability to incentivize our market makers are increasing, and hopefully the two balancing each other in such a way that our platform continues to grow and we're continuing to attract users.
Well, and we talk a lot as a space lately. It's a bit of a buzzword about intent centricity. But what's really interesting, one of the big criticisms of many centralized exchanges, because they're, very unregulated in this space, is wash trading and a lot of somewhat fictitious market making, kind of to your point. This, on Dexalot, you've been able to see that most of these transactions, because there's a cost, there's a greater level of intent and trust in that order book being
real,
right?
Absolutely.
And go ahead.
Yeah, I mean, And remember, the network level fees of how much is charged per transaction can be controlled by the operator of the network, or ultimately, when the network is open sourced, it can be controlled through governance, right? Imagine where the price of the asset is going too high, people can elect to reduce the fees so that the attractiveness of the platform continues. Again, it goes back to that point you made, and I think I tried to make, about managing the economy. The transaction fees drive the transaction burn lever, or rather drive the transaction burn lever, and by increasing or decreasing, you can control the velocity of transactions and making sure the network transactions are real. If you see a lot of spam activity and a regulator would like to sort of see this transparently, then transaction fees is a very direct way of combating it, right?
Absolutely.
So I believe that these types of platforms, once they're learned and understood through podcasts like yours, of course, will actually be a little bit better from the perspective of regulators. I know we're far away from that, but one can dream, right?
At some point, they're going to go, holy crap, we can actually see all of this stuff. And you can program a lot of the goalposts right into the protocols so that we don't have this. Do we think they're doing something nefarious or outside of what they're supposed? No. They are doing exactly what they said they're going to do in a trustless environment, which is obviously very exciting. Now, you're too humble to say this, so I'm going to do it for you. But Dexalot, if you take a look at the evolution of Dexalot in general, the transition from, at the beginning, there was no way to be net neutral or net deflationary because you only had a few of us that were like, holy crap, we're going to use this thing. But as you guys have scaled, you used inflationary emissions, and with the support of Avalanche, of course, just like all of us, you've been able to use inflationary types of emissions, but you've been able to kind of keep that balance nice enough that your activity grew, and now you're at the point of, like you said, 1 million plus transactions in a day, which is kind of mind-blowing if you think about it.
Absolutely.
It's incredible. And now you're getting to that point of somewhat maturity in the sense that you can actually start pulling some of those other levers. So the reason I'm bringing this up is, and again, I'm a pretty big fan of Avalanche as a general rule, anybody that knows, but that relationship has been very intentional. I mean, our emissions, and I'm assuming by extension, the way that you guys manage emissions with Ava Labs has been very structured. There's a lot of thinking and modeling and, paying attention to what's happening so that we make sure we try to thread the needle. And I mean, I think Dexalot, like we said, is a great example. Benqi's not quite there yet, where we've created the flywheel, but we're not ready to announce anything, but I think we're working on some cool stuff.
I am 100% Benqi's going to get there. I'm just going to say that. You're too humble to say it. I believe in you guys, and I'm a big user, so.
Well, yeah, and I mean, now with Avalanche 9000, for any Avalanche Maxis in the audience, coming very soon, and the 77 proposal, and all of these other things that are really going to make inter-blockchain communication incredibly efficient. It just opens up a total new breadth of opportunity and yield aggregation. I think real yield aggregation on platforms. Okay, so we're going to bring this in for a landing. We try to keep these for anybody that's listening. If you haven't watched us on FUD with Frens, every second Friday we do FUD with Frens, different topic, very similar to this. We try to keep it to half an hour. So we're bumping up on that a little bit now. But the last article I kind of wanted to talk about just had a little bit to do with, again, we've talked a bit about this, pros and cons of DeFi, and we've talked a lot about the benefits of DeFi, but sometimes the token emissions attract users during the initial growth phase. They often can lead to what we call a farm and flee. I call it vulture capital, but I guess everybody has their own naming.
Mercenary capital, right?
Mercenary capital. It's very transient, to say the least. I'll give you an example. When Benqi launched, we had the incredible support, obviously, of institutional partners and Ava Labs and many other people. And also we had the benefit of being one of the first movers with Avalanche Rush. And as a consequence of that, we went up to almost 4 billion or slightly over 4 billion in TVL within like 6 weeks, which is actually mind-blowing to think that it got there. But as evidenced by the decline when Aave came in and also had yield, it the yield then has to kind of naturalize itself down. So people are looking at Aave, they had less TVL, so it's a better yield for a very, very similar product. When you're thinking about the investability of some of these assets, this is kind of how I want to bring this home. Why do people even care about token emissions other than being a farmer? But Benqi, as an example, we had to learn some lessons as that happened on how to manage emissions. And I think we've learned some of them, as have you. But how should investors or participants in the space be assessing emissions and liquidity mining from an investment perspective? Not investment advice, of course. But how do you suggest people look at this?
I mean, emissions probably, given where we're at, is probably one of the top 3 things that you actually have to check, right? Do the emissions make sense? Because, we all have to form our own opinions. Is it too fast? And will it actually drive what the project says they will get to, right? Whether it's user acquisition or whether it's volume on an exchange or whether it's TVL for a lending protocol, right? And I always try and link the acquisition of users or people who are using the platform somehow to the emissions. Emissions can be used as campaigns, or emissions can be used just as to attract mercenary capital. Making that link that you said, where is this emission schedule or emission plan or managed economy ultimately going to drive farmers, or is it going to be interesting enough for people to come and tinker and stay for the long haul? So I would say this is top, right next to, does this product make sense in my head, right? Yeah. Once these 2 things do make sense, then I'm going to look at other stuff. But until these 2 together make sense, I wouldn't even look at the protocol, personally.
Yeah, so some things that I would suggest we ask of newer protocols is, how does your roadmap, if you get a chance to ask founders or in the early stages of a protocol, how does your roadmap plan to take advantage of that ramp up, using Dexalot again as an example, that kind of ramp up of inflation? And then do you have plans for what to do once you hit, let's call it, critical mass? The next thing that I would think about, and this is very much a banking concept, well, not banking, but you'll see it in a second, is what I would ask more kind of experienced protocols or established protocols is, what is your customer acquisition cost? What does it cost? And what is that initial customer generally worth? And what is your experience in increasing customer value over time? And if they can't answer that question, or at least it's difficult to answer that question in blockchain because you don't have people per se, you have wallets.
Wallets, yeah.
But it's something that we should be thinking about is, what does it cost to get a new wallet, in this case, to dehumanize the whole thing, to get a new wallet onto your protocol? What is the value of that wallet in terms of revenue potential currently, stickiness, and increase? And those are some things I would say should be, front and center of your analysis. Don't send me a DM yet and ask those questions, because I don't have the best answers. But
absolutely, you're correct. That's how it needs to be, right?
Yeah, in banking, that's totally what you're looking at, is how many new business lines can I open for a client? How do I increase revenue? What I'm really excited for, and I know you are too, we talk about this quite often, is when we can start valuing businesses and valuing ideas in the space based on objective reasoning and meaningful metrics. And so for all of you guys watching, we have a pretty good amount of people watching live today, which is exciting, more than normal. So I think you must have a bit of a following, my friend. So thank you for that. But yeah, I think these are the types of things that we should be thinking about. And the more that we all start to use a little bit more objective reasoning in our decisions and where to participate and where to invest, I think we'll drive the market towards that inevitable reality.
100% agreed.
My friend, where can people find more out about Dexalot and yourself?
Of course. Dexalot.com. That's the easy answer. But otherwise, you can definitely check us out on Twitter, or we have pretty good Medium articles as well. Obviously, Discord is another good place, or Telegram. Again, the traditional crypto communication channels, I would say, are all open, and we're all on Twitter as well. If anybody has questions, hit us up. We'd be happy to answer any questions or continue the conversation.
And I have to throw this in, but the axolotl is a really cool animal in the real world that I think is insane.
Fully agreed.
You guys have a mascot that is pretty cool and have done some really interesting things. So if you did the boxcar, Red Bull boxcar.
That's right.
thing.
That's right. Soapbox.
Soapbox, pardon me. And there's just all these little events that you see the Dexalot axolotl at. Bright pink, really cool. So look for it in Argentina. Of course, I'm pretty sure they'll be there in Buenos Aires for the Avalanche Summit. I know you guys have a lot of stuff going on, a lot of new kind of developments on the protocol and expansions and different things. So for all of our audience that isn't familiar, please go check out Dexalot. It's a very innovative platform that's really battle tested some incredible concepts. So it's definitely worth your time. With that, my friend, thank you so much.
Thank you for having me, man.
Love it. And for everybody else, go FUD yourself.
Peace.
With that, I have to say, go FUD yourself.
Go FUD yourself.
Go FUD yourself.
Go FUD yourself.
Go FUD yourself.